Good morning and welcome everyone to the Schwab YouTube coaching channel, Trader Talks for Trader Talk in today's market. I am your host, Kevin Horner. Thanks for joining me this morning, everybody, on this fine Thursday. Thursday is a solo class, but I am pleased to be joined by my friend and fellow Schwab coach, Mike Fairborn, in the chat. Take a minute and say hey to Mike. He'll get to comments and questions that I am unable to address for you live and in the moment, but I do try to keep an eye on what's happening there in the chat. Make sure where I can to bring your pertinent commentary to the table and part of our discussion. So please feel free to post in the Q&A for the duration of our show. We usually go about 45 minutes in total. If you're not already doing so, Mike and I try to provide for you posts on X throughout the week. You can follow us both there at Mike Fairborn CS, at Kevin Horner CS. It's a good spot to engage with us when we're not hosting classes here. That does afford us the chance to reply and speak with you on X. So please don't hesitate to use that. Additionally, if you're catching us in the archives on the YouTube channel, you should also know that the notes section beneath and your opportunity to submit comments and questions is also available in the archive. When you do so, those come directly to us as well, and we are happy to reply to those. So don't hesitate to use that functionality too. Now, before we dive into the charts, let's take a look at our disclosures and then we'll get right down to business. Please remember that everything we discuss today should be considered informational and educational only. We are not making recommendations nor endorsing any specific approach to trading the market. What we are offering up is insights and concepts that technical and analysts may incorporate in their own trading process and evaluations of the market, but we do not encourage you to base decisions on your trading exclusively off of what you receive in the way of technical analysis, though it can be a helpful decision-making puzzle piece, just not the entirety of it. So as we state here, please do not make decisions exclusively off what you get in the way of technical analysis. Now, we do have a number of frequent attendees in the chat here today, many familiar names and faces, but we are also joined by a number of newbies. So please, for all of you who are new here today, we take a top-down review of the markets. We start with the major indices. We will look at the S&P 500, the Russell 2000, the NASDAQ 100, probably some semiconductor review of that industry group as well, and some sectors on the move as well as stocks in the news. So kind of this top-down review will lead us towards an opportunity today to place an example trade, incorporating something from our order template known as the first triggers to OCO brackets. I'm going to speak about that a little bit and try and provide you traders with a way to enter one single trade but exit in multiple levels in price. So this will be a way to plan a trade and then adhere to the plan you set for yourself. Hopefully this will prove to be helpful. We'll work through that in the final 15 minutes of the session. So with that, we're going to kick it off with a look at the S&P 500. We always do. So I'm going to start with that, SPX. We still know that we've got that breakout, and yesterday we made a new intraday high, faded into the close a little bit, but by no means a pullback that should not be at least relatively comfortable. Obviously, we don't like red candles, and yet we've made a move to new highs. It's hard to be anything but bullish given what we've witnessed here, having moved out of the consolidation we've been under for the better part of the last 3 months or so. We get outside of that now, and we have perhaps cleared the route to more highs. Now, the extent to which those highs can be achieved remains to be seen. We know that we can measure potential moves through a number of key ways. We can take the height of the range that we've exited and add it to the top. In doing that, it gives us a potential target in the ballpark of 8,000, believe it or not. But before we do that, we've got to clear 7,800, which is pretty much close to the high of what we got yesterday, 77.93 and change. So we know that we can't say that it's only upside from here, but we could suggest that given the recent breakout this week, that we have a view that the greatest or the the path of least resistance would be to the upside from here, given the breakout. Now, we shouldn't be surprised if we get thrown back to the breakout level for a test, whether that's equal to the 7620 area or maybe even the 20-day moving average, which is a little bit lower today. That resides, let me see here if I can see it in the link up there. There it is, 75.17 approximately. So any throwback to the breakout spot would be potential entry for many SPX traders, and a throwback to even the 20-day moving average might be as well. And that's simply because as we move out of a consolidation, it is not at all uncommon to witness the trend begin once more in earnest. And that would imply for many traders utilizing a faster moving average. So that would be like potentially a 20-day in orange, or maybe even a 10-day here in yellow. You'll notice how as we've gone sideways, that 10-day moving average has carried no weight for price action. But now we are above it for 5 sessions, and we've made a pretty good move in doing so. So let's see. Maybe the 10-day starts offering some support in a new short-term uptrend in the SPX. So that's what we're watching for here in the SPX. It's certainly a good start for this week. And if we looked at this on the weekly chart, I've got some measured calculations drawn in, but you can see, I'm going to clear that out for you. I mean, essentially, everybody, this looks just like a longer range weekly bull flag, doesn't it? And now that it's been broken to the upside, it's really hard to call that anything other than bullish. So we're going to continue to do just that. Bullish in the SPX. As always, know the levels where you would change that viewpoint so that you can take action as you see fit. Now, let's go ahead and check on the NDX. The NASDAQ, due to some big reporting companies overnight, starting a little bit in the red today. We're off about 0.5%. Now, this, generally speaking, is not a terrible development given the move we've made this week. Let me zoom in. It's also going to look a little bit on the weekly chart like a long-range bull flag again. But let's talk about the level to which we fell today. Many of you are frequent attendees. You know the importance of gap levels, right? Well, we're going to talk about the gap level this morning. You know, we had this big gap up on Tuesday, and today that was the level at which we opened. So our low on Tuesday was 29,109. Our low today was 29,123. Missed it by about 14 points. But we saw buyers coming in above the gap level. So that tells us there is interest, there is bullishness and support at that spot. Does that mean it has to hold today? Unfortunately, no. We can't validate that in the first 5 minutes of trading, but we could say that all of this action to get it back above the 20-day and break what was essentially a pretty short-term downtrend like this has now been held. And this gives the view, if nothing else, that a trader could basically say, hey, under the lows we have just set for the day, I need to get more defensive if we trade below there. And if we trade above the high that we made yesterday, then it's going to be more comfort for risk on. So as usual, we know price doesn't tell us definitively what's going to happen next, but what it does give us is the best manner to manage our risk. So if we looked at this on an hour or on an intra-period basis, I'm going to use the 1 hour chart. There is my drawn in rectangle. It looks pretty clear and evident where short-term support is. And if we were to slip through the low we made here, well, then maybe we have to fill in the entirety of the gap that we made from Monday into Tuesday. So this becomes the next layer of potential support. By the way, that blue flattening line there, that is the 200-hour moving average on this chart. So this is a 30-day chart, 1 hour bars incorporating after hours moves and whatnot. And that's why we have the blocks, right? Because these indices don't trade overnight or pre-market, so you get these big moves. If you wanted, you could utilize maybe futures symbols to do that, just to track price. Of course, not speaking to the validity of trading futures, but you can do so if you're looking for something a little bit more clear in those after hours sessions. But I feel like we've well defined a level for short-term support in the NASDAQ just based on the last three sessions here. And unless and until we trade under 29,100, I think bulls are remaining optimistic in what they're getting out of the NASDAQ. So we'll see if that carries. Now, last on the big three, let's look at our small caps. Russell's off 0.25%. Did close at a new all-time high on Tuesday as well, breaking this consolidation, showing strength that maybe we don't necessarily expect. The yields continue to be elevated. The conversation around higher for longer has been persistent, and yet here we have the Russell 2000 trading at all-time highs. Now, that can definitely change. As you all know, the 20 period has not been terribly consistent, unfortunately. It looks like the 50-day remains the most consistent trending moving average for the small caps, but there is an extended low here from early last week that basically gives us a ledge of short-term support. And the reason that could be viewed as short-term support, everybody, is under that level on a closing basis, we would have a lower low. Lower lows in the midst of an uptrend change potentially that trend. So if we got back to the 50-day and bounced, trend remains the same. If we got down to 2,900 and bounced, the trend remains the same. If we get under 2,900 on a closing basis, now we have potentially something different, and that could be an area where traders get a little more defensive. And so, as always, know the levels where it's important for you to take action on the positions you're trading and be able and willing to actually follow through and take action. We often say that the important aspect for a trader is to plan their trade out from start to finish, best case and worst case. In fact, lead with the worst case and follow up with your best case, right? So you know definitively what you're stepping into. But we plan our trades and then try to trade that plan to the letter. That's where we have the greatest opportunity for long-range success, is through consistency of process. And that's what we speak about quite a bit here today. Hopefully the last third of today's class, when we talk about that order entry process, will help solidify that concept for many of you. All right, so there's a look at our big three, our SPX, our NASDAQ, our Russell 2000. Let me just take a quick look at the chat. It's pretty active here already this morning. Lots of new faces. Love seeing it. All right, and for those of you wondering, I want to just give you some additional context into my charting here. I work frequently with the most basic moving averages. I don't think it's terribly important to be very specialized in the indicators and oscillators we utilize. I think traders can get a little bogged down by incorporating too many details, and I often think of those indicators as clubs in your golf bag. And the reason I say it like that is that each club in the golf bag is different and serves a different purpose. And so not every study is going to be pertinent and appropriate every step of the way. But at certain times when price action is giving you certain indications, then it is important to look at some of these indicators in more depth, okay? But for my process and for one of simplicity, we work with a 20-day moving average, that's my orange line, a 50-day moving average, that's my purple, and then in blue, the 200-day simple moving averages. And again, this is just trying to keep it simple, working with the most frequently utilized moving averages. This does not imply in any way, nor should you infer that it means that these are the right ones, right? These are just the moving averages that I use. They're the ones that I was trained with when I learned about technical analysis way back in the late 90s. And these are consistent for so many traders. And remember, self-fulfillment is part of technical analysis. Self-fulfillment simply states that to an extent, the reason charts are somewhat functional and successful for chart analysts is that so many other traders are using the same concepts and strategies that they are. And so the more that believe in the concepts and utilize the concepts for order entry and order exit, the more reliable these ideas can become. So with all of that, Let us move off of the big three. Let's talk about the semis. Of course, we want to see the semiconductors getting back into gear. I've got a lot of lines drawn in here. We're going to have to clean that out, everybody. So here we have semis still under a little bit of pressure, but working to get back into trend. This is a very important chart for not just the semis, obviously, but for the broad market as well. That's why the bounce we've gotten this week out of technology, the NASDAQ 100, and semiconductors to a certain extent, has been what's carried the SPX to those highs. And it's why you're not seeing the NASDAQ quite exactly where we want it just yet, right? We've moved higher, but we're not at highs. And that's because the NASDAQ doesn't have the component breakdown that the S&P 500 does, benefiting from stocks in financials and in healthcare and industrials and these groups that have been doing well while the semis and technology have been pulling back. What I find interesting on the semiconductor chart, a couple of key details here. We are in a process of defining whether the downtrend has broken. Okay, that would be a broken downtrend. If we drew the line like this, it would look more like, oh, not quite yet if we drew it like this. This is the one drawback to utilizing the manually drawn trend line. But recognize that, you know, the manually drawn trend line is really more for purposes of understanding what the current trend is, and we're fighting it out at the 20-day. Now today, then you'll notice that the low in the SPX, the SOX here, where did it come to? Basically this ledge right there. So we filled in that gap from not the entirety of it, but from the closing high or the opening level there back on the 31st last week and bounced off of it. Let's see how that looks intra-period here. All right, so all my lines are still pretty evident, right? So we filled that gap slightly, and we've got bulls stepping in, and they stepped in and carried us. So we're already back to 12,000 here on the SOX. So we're right back at the 200 period moving average now. And if we can get above the high we made, well, then obviously we're looking at maybe the continuation move for semis. But I think that the daily chart illustrates the importance of that. There's that same high, right? We need to get above that level for a view of continuation in this new short-term uptrend. That's what we'll be wanting to keep a close eye on. There was an execution on one of my orders there on one of my other classes, the teaching, we call that one building a stock portfolio class. I offer that one on Tuesday afternoons, by the way. Today, when we go through that individual example trade, it's going to be a little bit like my Tuesday class. So for those of you interested in a little bit more of the stock analysis, individual equity, and building portfolio through examples of individual stock trades, check out the Tuesday class, 4 p.m. Eastern. We've been offering it with this concept since January, and it's a fun class for me because often all I'm doing is raising stop orders and starting new trades. It's a fun way to manage my positions that are examples on the market, and we run through the various sectors that are moving and providing leadership to do that. So if you're interested, check that one out Tuesday afternoons. Okay, so we like what we've seen out of the SOX, but we need basically to maintain the short-term support here. We do have a short-term higher low. What we need to do is get above our last highs. I gave this level in here. You'll notice that it happens to be close to the last highs we made back in this area. So really, ultimately, we really would like to get above this group here and even the 50-day where we'll start to really feel a lot more comfortable with the semis. All right, let us see, about 10 minutes. Okay, quick hit on oil so we can look at the big moves in oil, not just crude. We use the futures symbols here for this. We do not advocate for futures trading. You are eligible to trade futures at Schwab. You do need to be approved to do so. So make sure you go through the steps to do that. But what we're going to do today is simply talk about crude oil. They'll look at gasoline as well with the future symbol and the diesel future symbol, which is basically heating oil as a proxy for diesel. Now, The big thing here in the crude is a little bit of a bounce today, and of course headline driven. But the lines that I've drawn in here are perhaps the ones that matter the most. We have failed at our downtrend line in oil a number of times here, everybody. This is one fail. There's a second. We even have a third fail right here. And so each bounce has been to a lower high, and we are basically still digesting the entire breakout and throwback. We're right in the middle of things. We're hanging out at the 200 period moving average. It's tough to know at this point whether we are going to get a continued bounce, but you do have the 20-day crossing the 50. I wouldn't put a whole lot of stock in that given where we reside below both of that confluence there. But any bounce over the 50-day, given what we've seen in the downtrend, may very well mean any bounce through the 50-day can give you another lower high. When things change, well, we would need to be looking for a higher low first, right? We could be considered to have a higher low in here, but until we make any kind of higher high, we don't have a break of the trend. So there's not a whole lot to do as it relates to oil, though we are in a range that's certainly considered to be tradable. Now, when we look at this here, the crude is, reminder, covers so many details across the board for you. It's not just crude. It also incorporates the gasoline and diesel, okay? And we talk about those with slightly different symbols. So let me look at those with you. The gasoline futures is RB, and you'll notice that we've been kind of pulling back a little bit with the price of crude dropping, but we're sitting at support here. So I hope you're doing better at the pump than I am. My pumps have not really come down in price the way that I would like, but this is an interesting spot, could be considered to be support for gasoline. The area that's most of note to me as it relates to our conversation around inflation is on heating oil, because this is the proxy for diesel fuel, and we use diesel, of course, for transportation across country via the trucks. It's a big aspect of the cost that comes in at the end to all of us consumers. Now, what's the reason I'm bringing it up is this looks a little different than crude, doesn't it, everybody? A broken downtrend line led to a rally to new short-term highs. Remember, the original highs were back here, the midpoint highs were back here, and we made new highs up here. Then we got thrown back to the 50-period moving average and have now moved off of that. So we are getting actually a bounce at the 50-day moving average. Now, this pullback has not, as of yet, given an entrance signal short of saying, oh, we tested the 50-day. And so let me explain that. A trader here could certainly feel comfortable stepping in and believing that, and again, talking about this from a standpoint of price action and technical viewpoint. Don't apply this to futures trading specifically, please. But under the 50-day, a trader who took position today would say, all right, that's not happening the way that I thought. Let's move on from this trade. But another alternative would be to look at the day we made our lowest low in price, and I think that is back here on Tuesday. The low was 367. Yep, so 367 was the low here. And if a trader were looking for some semblance of an indication that this is truly ready to reverse and start heading back higher, we would often look as a trader to the potential for a hold. That is to say, a close above the highest price on the day that the instrument made its lowest price. So the day we've made the lowest price in this pullback was here. And that low, we're not as concerned about. We're concerned about the high on that day. And so if this were to trade over the high on the day we made our low, we'd call that a hold, a close above the high of the low day. And that could be an indication that would bring traders back in. It also could be the indication that what we've seen in a pullback could be considered to be over and the trend could reassert itself. So all of that is important because of the inflationary pressure that higher fuel for diesel could provide at the end bottom line for the rest of us. Okay. So this is why we're watching it in this class. And we try to keep a close eye on it because inflationary pressures have not abated. Some of the numbers we've heard in recent weeks have suggested that they could. And the move lower in price of crude has been helpful for sure. But the other reminder is that it takes a while for a lot of these shocks relative to the oil space to play out. And so this might be a short-term look, but it also could have longer range impacts. Okay. All right. That was a lot. So let's now move off of the futures conversation. Let's jump to our Market Watch tab and the quotes page. We're going to look at our year-to-date returns. Just yesterday, I noted that we have flipped all of our 11 sectors on a year-to-date basis in the green. That is not a terrible thing, is it, everybody? That tells us that we have a strength and breadth in this market that may not have been expected. This market is carrying and showing that strength. We can show that strength another way, and I didn't highlight this originally, but we could have. Certainly the SPX equal weighted index. We've been talking about this as well, how it has greatly outperformed the S&P 500 in terms of the leadership here. This was making highs even before the SPX was. The SPX did this week because of the rally back in technology. Well, we were making highs, the week prior in the SPX EW. And so we're not at all surprised by this. The 20 period's been okay for trend management. Moves below it have been opportunities for participation, but it's really more cleanly viewed with the 30-day. If I changed my 20 moving average to a 30, which instead of 4 weeks would be 6 weeks, of course, look at how consistent that has been on that equal weight. Now, we know that that's not guaranteed to be going the same going forward, but it is nice to find that level of consistency in trend anywhere you can, everybody. So I really like that look, and it's a real good reminder of the breadth of this market. And speaking of breadth, I'll just bring back the market breadth chart, which allows us to see the stocks in the S&P 500 trading above their 200-day moving average. We've got a good opportunity to see that move once more to new highs. Same for stocks trading over the 50-day in the S&P 500. You'll notice our NYSE is not exactly making a ton of new highs like we were in early year. So we're a bit more, hanging out, if you will, but that's from the NYSE side of things. You'll also see, but we do have not very many NYSE stocks making 52-week lows, right? So we're not at the ultimate low of new low stocks. If you go back to April or late March, I should say, you'll see that was when we were most under pressure as we had received plenty of detail around the Iran conflict here, leading to a lot of new lows. So the breadth has improved. We don't mind that at all. Let us utilize that and talk about some of these sector maneuvers in here. So we are getting a bounce today in energy, which does kind of stand to reason, right? We saw the crude hanging out at the 200-day moving average. We've got a short-term 20-day moving average crossing the 50-day to the upside. I saw that request. Let me help you all out. The request being for the grid here, the market breadth grid. We can absolutely share this with you, everybody. For those of you who might be new users of the Thinkorswim desktop, here's how you get that loaded. We go up to Setup, Open Shared Item, and paste it right here. So don't click the link, copy, and then paste it right here. When you paste it here, everybody, hit Preview, and then Import. And when you import it, it's going to open that in a separate window like this, and then it will then be one of your available grids. In fact, you shouldn't have to search for it, or should not have to resave it. It should be right there. So there's mine right here, market breadth. But double check that and make sure that it is one of your saved grids before you eliminate it. Okay, everybody? So I will share that here in the chat for you all. Just as a reminder, grids, scripts, all of this stuff, none of them are guaranteed for accuracy nor timing. So, but I do hope that that is helpful. Rachel spends quite a bit of time charting for us and helping us out. And she was so kind to share that one with us recently. So, okay. Now, looking at energy, what I found interesting was this. We broke that downtrend line right there. And what we've done since has held the new trend. So every bit of price action since breaking the downtrend has held the downtrend line. And remember what I said about this with the S&P 500 when we get a break, whether it be a downtrend line or a breakout to new highs, it is not uncommon to thereafter see a short-term moving average providing support in a new short-term trend. Well, that could be what we're looking at with the 20-day there in energy. So an improving chart for the energy sector across the board. Let's also take a peek at, let's see, so discretionary did get a rally here recently, moved off of a really long range low. Looks like a very, very wide or deep, I should say, ascending triangle. Lots of resistance overhead. Really hard sector chart to get a gauge on, though, everybody. As you can see, it's all over the map. And there's a lot of charts in the marketplace, of course. We don't have to spend time scouring rough charts to trade for finding the best ones. We shouldn't have to look at a chart for longer than a minute and say, moving on. And unfortunately, as I look at discretionary, this is one of those charts that looks like a moving on type thing, right? Because there's not something clear and obvious, and there's enough charts to work with where we can be clear and obvious. Staples, also really not moving, is it? We do have a pretty well-established range. Notice the 50 and the 20 converged on each other here, the confluence there in this area, but it's, again, not trending, so not really very helpful. What about healthcare? Slightly different situation, right? We have noted that we've moved well through prior highs, like right in this area. And then that became a support test, right? So resistance, 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 pull back to support, breakout. What was resistance can become support. That's what was going on back here as we were building out this bull flag. And then we resolved that bull flag bullishly. Now what we want to see is maybe there's a measured calculation that we could put on this, something like that. And we can duplicate that line, add it to the let's add it to the bottom of the flag, basically, for a more conservative opportunity for a target. And then that would give you something like that, everybody. So right in the vicinity of 2025 or so on this index for the sector, or rather the sector symbols, that is. And obviously that would be a great development, but there's no guarantee we get up there. But what it is nice to see when I zoom in on this, everyone, is the 20-day moving average all the while has been supportive, hasn't it? Back in June, we broke out, come back, tested it here, tested it here and here, and that 20-day just keeps rising. So healthcare is a nicely improving group. It's something we've been talking about quite a bit in Trader Talk for the last few months. All right, here's a look at your financials. Very similar in scope, moving up quickly now. After the consolidation above the 50-period moving average, we've seen one bull flag, another bull flag, another bull flag. This thing just keeps showing bull flags. Financials remain strong, though under pressure today. A very limited amount of under pressure at 0.1% down. We're going to talk about tech today. That's where our example trade is going to come from. So what we're going to do in looking at technology, you can see I've drawn in that, once again, that bull flag. And when I zoom in on things, noticing that today's weakness once more was bought up. So yeah, we were below the low of yesterday for most of the morning early on here, the first 30 minutes, and then traders just bought that up already. So we're back to 69.45. We're already up 10 points from yesterday's close in tech. Did not get down to the low, the gap ledge there, so not a concern as of yet, but that could be a support area for technology. But we like being outside of that down channel, don't we? We are now day 3 outside the channel. Today could be confirmation of the continuation of the uptrend for some of you traders out there if you're using time above a breakout level to validate the so-called breakout, okay? Now, with this move, What we're going to do today is incorporate the process that I take to the table for the building a stock portfolio, and that is a very standardized process. I'm going to load a watch list. That watch list I'm going to link into my chart. So I'm making that a number 5, so it links up here. I've also got specific columns I like to work with, so it makes it really simple for me. And then I'm going to my personal list. My personal list here is uptrending all time frames technology. Now, what does that uptrending all time frames mean? It means that anything that's on this list, A, is an S&P 500 stock, B, is trading above its 20-day, its 50-day, and its 200-day moving averages, just like the technology sector is once more. Okay, and so we will always, what this offers is an essentially a view of leadership within a group that a trader might expect to have more upside. Doesn't mean it has to go higher, but we do appreciate what's gone on in the last 3 sessions as we have not only broken out, but maintained the breakout. Okay, so the stock that came to me today was Cisco. And it's because partially it looks quite a bit like that technology chart, does it not? So look at the drawdown to our lows. We saw a peak to trough maneuver of 17.75%. Okay, so it pulled back pretty well, and then it recaptured the 50-day just like technology. And if I drew a downtrend line through the highest high we've seen, many traders would say, well, now that we've broken the downtrend, now once more the path of least resistance may very well be to the upside. Now, taking what we've already covered and viewing this position today, I'll point out, look at that intraday low. Is that a valid low yesterday? Let's see. Doesn't look like it. That low yesterday suggests that it was at 114.88. I don't think that's a good low because that would have been down here. And you'll see from Wednesday morning all the way through, really the lowest low was 121. So let's make note of that. 121 was really the low. And that's important because that's not a 20-day test. So let me just point this out, everybody. We can adjust your calendar, or pardon me, your candlestick by going right here, correct this bar. And when you do that, you get this brought in, okay? So you have to, these are the values that are noted. That's why we see that long tail at the 20-day is because we have a bad print for a low. So I'm going in here and I'm going to put the low at that 121 level and hit apply. And when I close it out, now you don't see that tail all the way down at the 20-day like you did originally. Okay, so if you get some indications from your candle that are less valid, make adjustments so that you ease your visual process a little bit. Usually, K Brown, it's a bad print from the exchange that leads to that more often than not. All right, now with Cisco, what I want to do today is incorporate that first triggers 2 OCO brackets. And the reason is we want to be able to stick with a majority position. I want to sell some at maybe the prior high. We're going to call it I'm going to use round figures today. We're not going to do an in-depth process, but more of a step-by-step focus than anything else rather than specifics on price. Okay, so just bear that in mind. What we are going to look at is the idea that we could step into a 100 share position, look to sell half up here at 130, the prior highs, and maintain the other half for future opportunities. We also want to have a layered exit should things go against us. So we'll layer an exit under 115, which is the 20-day moving average, and then at the last low as well, just as a last spot to move on from the trade. Okay, so I'm going to say, while in this instance, I am not going to incorporate average true range to build the stops. I'm going to just go beneath these areas of what I'm calling support, okay? But in Tuesday's class, when I do this in more depth in the stock building, building a stock portfolio class, we spend a lot more time detailing the use of average true range to aid us in building our exit strategies, okay? Today's focus is simply on order entry and partial exits at various prices, okay? So what we're going to do is place a buy order at a ballpark of 122. I'm going to right click, buy custom, and I'm going to slide down here to first triggers to OCO. That's going to give me 5 orders, everybody. One of those orders is the initial purchase, buying 100, and I'm going to put it in at a limit of 122. Okay, good for today. Then we're going to sell 50 at 130 or better, good till canceled. Subsequently, after we own it, as important as that limit sell at 130, everybody, we got to get that stop order in for protective purposes. Remember, our stop on the first one is going to be based on the 20-day moving average, which is just over 115. So we're going to come beneath that. Not by what I would ultimately utilize in my class, the ATR, but maybe $1 beneath it and try to use non-round figures. So let's go ahead and say 114.58. How's that sound? It's an odd number. It's not a 0. It's also beneath the 20-day moving average. Additionally, though, we got to do the exact same thing on the second block. So we're buying 100. We're bracketing 50 for sale at 130 or stop at 114.58. The next one, let's set the subsequent high at maybe 135, an extra 5 points. In the instance it breaks out, change that, good till canceled. And then the next stop, we got to go back to the lowest low we had. So remember, the low we made there was 107.53. We want to come beneath that. So let's go under 107. Let's make it like 106.94. And again, just focus on process here, everybody. Okay. Now, here, the big takeaway is this is what gives us the opportunity to sell a portion at an elevated level and still have that stop order protecting us. Remember, the stop can't guarantee price in any way. So when we get down to the first layer at 114.58, if it triggers intraday, we're probably going to see execution close to that. However, if we close above 114.58 any day of the week, and then the very next day we opened well beneath it, let's say we opened at 110, well, then our execution is going to be pretty close to 110, not close to 114.58. We still have gap risk, okay? So got to keep that reminded. Now, let me see here. Yes, Lori, great question. If you've already purchased the stock, is it possible to, after the fact, do the partial sell and brackets? The answer to that is yes. You can do that most easily via the monitor page where you have your shares. So you can go in and right click in there, and that'll give you the opportunity. I'll highlight that for you momentarily. So first of all, let me go ahead and share this trade or get this trade executed, entered into the platform. It's going to execute right away because we're putting in a limit at 122 or better. So this price is currently better. So let's hit confirm and send. All right, and make sure you read through your details. But again, the thing I think is so helpful about this, everybody, is that you know in advance, if I buy, here's where exit is for 50 shares. Here's my profit exit. Here's my stop exit. Here's my other 50 share block. Here's my profit exit. Here's my stop exit. You can walk away feeling relatively comfortable with this process, knowing your best case and worst case scenarios. So there's our execution. And we've got those limits up there. So if I shrink this down, you can see them. So there's each limit and here's each stop. So we've got the position in and we are ready to go. We've got profit targets. We've got stop targets. We are, relatively speaking, comfortable. Now, I did a class, or rather a quick video on this first triggers to OCOs recently. You can find that on the channel as well. It often appears at the end of these classes too as a link you can click and watch. It's about a 6-minute video. It'll take you through this exact same process with a little bit more clarity. Feel free to watch that as frequently as necessary. So, to highlight your question though, Lori, let me just go back to the monitor page. Now, all of my positions have existing exit strategies, so just be aware of that. But if you were to right click on one of them, you can create a closing bracket right here with OCO bracket. And remember, while we recognize you're getting familiar with the platform, we have support available to you. It's not just the YouTube channel. You can reach out and speak with a representative on the phones every day of the year, 24 hours a day, 7 days a week. I staffed that line for about 17 years here at Schwab. I loved having conversations with you clients about that stuff. Order entry, strategy discussion, all of it, getting you squared away to make sure that the orders you're entering are the orders you want. So don't hesitate to reach out and have a representative on the line with you as you walk through your trade. Now, we are at time, everybody. I so greatly appreciate you all sticking with me today. This was a really nice opportunity to highlight that first triggers to OCO brackets. Big thanks to Mike Fairborn in the chat today. If you're not already subscribed to the channel, please do so. And if today's conversation helped you at all, hit that thumbs up button down below for me. We get this reviewed. It'll be in the archive here shortly after today's completion and available for viewing for all shortly thereafter. So that thumbs up will help all viewers that couldn't be here live today to get an opportunity to catch this in their own time frame. So follow Mike and me on X as always, and I look forward to being back with you again soon. I'll be back tomorrow morning for Trader Talk. A Friday session with James Boyd is a non-archived session. So if you're interested, you got to be there live. We kick it off the same bat time, same bat channel, market open, 9:30 a.m. Eastern tomorrow. Have a great Thursday, everybody. I look forward to seeing you all again real soon.